Hello everyone, it's Daniel Martin and this is the Golden Trader Program podcast. So today we're going to talk about a risk management. How important is this for all of you? The typical risk that people say it everywhere, that it must to be this percentage, that percentage, that is totally wrong. It's much more complex and much more a detail for each one of you. It's not everyone have the same risk tolerance. And this is actually what we're going to work on it. So what we're going to do is go through the podcast, and we have again, Peter and Maria discussing this article, and I will add some extra annotation if it's needed. If it's anything wrong, I will actually correct it. So it's pretty much is to have, if you don't define risk, you will not survive in the long run in trading. So simple like that. So it doesn't matter how good is your system. So, okay, let's working out the podcast right now.
Today, we're wrestling with a pain point that I think really defines whether a trading career lasts for 3 months or, 30 years.
It's a huge one.
We've put together a stack of sources that don't really look at strategy or indicators. Instead, they focus on the operational survival points, the things that separate the professionals from everyone else.
That's absolutely right. And our mission today is very, very targeted. We want to help you move beyond just the conceptual idea of risk.
Right. The idea that risk matters. Everyone knows that.
Everyone knows that, but it's not enough. We're talking about getting to an operational understanding. It's about building a system, a real framework that is so robust it can survive the, frankly, soul-crushing volatility the market is going to throw at you.
And that brings us to the core mystery, this question that just hangs over everything else. It's the pain point we hear all the time.
Mm-hmm.
It's, why do I still experience these huge drawdowns, this incredible emotional pressure, and just wildly inconsistent results, even when I feel like my strategy and my analysis are correct?
And that question feels like a mystery because the answer is so counterintuitive. It's this uncomfortable truth that, professionals just get in their bones.
Which is?
Most traders don't fail because of bad trades. They fail because risk magnifies every single mistake.
That's it. That distinction changes everything. We often talk about risk like it's a brake pedal, something you use when things get a little hairy.
Yeah, defensive tool.
Exactly.
There's something, sorry, that I've been saying many times. Risking too little, way too little, you don't care. Risking way too much, you care too much too. So both of them is out of control. You need to find balance. So let's continue on this.
But the sources we looked at, they define risk completely differently. It's not a component. It's the fundamental multiplier for your entire trading operation. It's what turns a tiny little leak into a sinking ship.
It is the multiplier effect. If you only remember one thing from our conversation today, that should be it. Risk is the lever that determines your fate. The contrast is just. It's brutal.
How so?
A stellar strategy paired with management fails 100% of the time. It will fail. But a mediocre strategy, just an okay one, paired with ironclad risk control.
It survives.
It survives. And survival is the entire game.
I think that's where that gap you mentioned, the operational versus conceptual one, is just so wide. Conceptually, everyone agrees. Yep, risk matters. But what does operational risk management actually look like?
It looks like structure. It looks like architecture. A conceptual understanding is like reading a book about how to swim.
Okay.
Operational risk is the structure of the pool itself. It's the walls, the depth markers, the lifeguard on duty. It's about building your exposure so deeply and carefully that you can survive anything. Long periods of nothing happening, then the shock of high volatility, the pressure of drawdowns, and ultimately, a long career.
And just to give everyone a sense of the depth required here, our sources identify, I think it was 9 related areas you have to master just to get past the basics.
Oh, it's incredibly comprehensive. It's not just about setting a stop loss and calling it a day. We're talking about everything from position sizing, which is almost always done emotionally, to mastering the real nuances of your stop loss structure. It's about building a psychological feedback loop that can actually handle losing. And, critically, it's about how you scale the entire system as your capital grows.
That scaling point is huge. The system has to grow with you.
It's an entire system design. The moment you realize your risk framework needs to scale, That's when you understand why the operational approach is the only one that matters.
Okay, so let's get into that operational blueprint. If risk is the multiplier, then the goal is control. The sources lay out these 4 foundational pillars, actions you have to take before you ever place a trade.
Yes, and this is where we move from theory into actual implementation. The first pillar is completely non-negotiable. It's defining your maximum acceptable risk.
And this can't be a vague feeling.
No, absolutely not. It's about building safety buffers, real guardrails into your operation.
So what does precise look like in practice? You can't just say, oh, I'll risk whatever I'm comfortable with.
Precisely. That's a recipe for disaster. It means setting rigid mathematical parameters. You define your maximum acceptable risk per trade, say 1% of your account, then per day, maybe 3%, and critically, the maximum total drawdown you will ever allow before you stop everything.
The emergency brake.
The emergency brake.
Yeah.
If you say 20% is your account's limit, the moment you hit that, you are done. You stop trading, you reassess. Those numbers are your rules of survival. They're not suggestions.
Okay, so if Pillar 1 defines the boundary, Pillar 2 sounds like the engine of consistency. It's standardizing position sizing. Why is sizing so critical?
Because position sizing is where emotion finds its easiest entry point. It's the door it sneaks through to sabotage you.
So remember about this particular point, what I said earlier, is when you got that, it's not about the 20% neither, it can be 10%, can be 5%, your pain tolerance is different. So you need to find the point of that we discussed earlier. When you define losses, let's say that you're going through we talk about that 100 pounds is too much, 1 pound is nothing. This as an example, yeah? So let's say that your maximum loss tolerance is, if it's 100, your emotion is going to the top, to the maximum momentum. So if you go 1,000 pound account and you lost 100 pounds, you lost 10%, you're gonna get quite emotional. So it's quite dangerous. You're going to the danger zone to risking more when you lost 10%, because that 100% or that $100 is actually your maximum limited of tolerance. So it's important to be aware of this. It's not about particular percentage, it's about what is painful and what is not, and what from pain it can go out of control. And that's the key, to be in control and in balance always. Even losses, week, monthly, year losses, whatever you actually name it, be sure always that. And when you grow as well, you need to be in control. When you make too much money, it's the problem as well. How do you control your greedy? How do you make sure that you don't go out of control and risking more? Always it need to be in back to balance and control. We're gonna work on that.
How does that happen?
Well, think about it. You have great run, 5 winning trades in a row. You feel invincible. Your natural inclination is to size up emotionally on the next trade.
Right, press your luck.
You press your luck, and that one trade, if it goes wrong, can wipe out all your previous gains and then some. Conversely, you have a bad run of losers. You get scared. You shrink your size down to almost nothing. So when your strategy finally does hit a winner, the profit is too small to even matter.
So standardizing your size takes the emotion out of it. It ensures that whether you just won 5 times or lost 5 times, your exposure is consistent.
Exactly. And that consistency is the only way the probability can actually work in your favor over hundreds of trades. The capital you allocate has to be predictable. Your position sizing should be a function of your risk limits, not your mood.
Got it. So Pillar 3 gets into the nitty-gritty of loss control. Controlling losses precisely. This is about the stop loss, but the sources treat it very differently than a lot of retail traders do.
They are crystal clear on this. Stops must be treated as rules, not suggestions. A stop loss is an operational instruction. It is not a point of discomfort that you can just move if the price looks like it might be about to turn around.
We've all been there. Oh, absolutely. If you are constantly moving your stop, or worse, canceling it altogether, you are not managing risk. You are managing hope.
And hope, as they say, is not a strategy. It's that moment you say, I'll just move it a little bit, or just let it bounce back. And that's the moment a precise, controlled loss becomes an uncontrolled disaster.
A disciplined trader defines the stop as the exact point where the original thesis for the trade is proven wrong, invalidated. Once that price is hit, the decision has already been made for you. Precise loss control means removing your discretion in that moment of pain.
Which leads...
See, you need to make sure that it's actually, the stop loss is not a level. It must be defined a level and a pain tolerant. So you see, you go 2 bars. What is actually, okay, this is my location for exit. That I believe is the right to get out because it's my analysis, my technical analysis, whatever the reasons you have for it. But that amount is being lost in there. how painful is that? And that's how you measure your loss. Don't make it too large, too small. What about moving the stop loss or not having a stop loss? Something that for me is killing me mentally. I don't understand that, how it can be possible to do that. But I do understand why it's been done. It's another foundation problems coming earlier. So be aware of that. Just focus into the feelings of get a loss, a particular amount in a particular location. Assume that will be a loss there. How were you feeling about it? This is important.
It's to the fourth pillar, which is about the long game, preparing for volatility and longevity.
Yes. Designing for longevity means you accept from day one that periods of high volatility and extended drawdowns are not possibilities. They are guarantees.
They are going to happen. They are going to happen. So your risk rules need to be rigid enough to protect your capital, but flexible enough that the system doesn't just completely shatter when markets get chaotic. A system built for longevity ensures that when that inevitable bad period hits, you survive financially and emotionally. So you're still there to trade when your edge comes back.
If your system forces you out of the game after one really bad losing streak, it wasn't built for longevity. It was built for ideal conditions.
Which never last. Survival is the strategy.
So what does this failure look like in the real world? For the listener who knows this stuff conceptually but isn't implementing it, what are the specific consequences?
The cost is extreme.
Right.
And it shows up in two ways, financial and behavioral. Financially, it's obvious. You experience these huge capital-destroying drawdowns. But behaviorally is where it gets really toxic.
Okay.
You lose control. You start to see this intense emotional instability. You're over-trading. You're revenge trading after a loss to try and win it back immediately.
Oh, that's a killer.
It's a killer. And it's followed by this reckless greed after a win. You end up destroying any ability to compound your capital over time.
It's that psychological feedback loop that just gets totally poisoned, right? Because when your capital is always facing this existential threat, you can't think clearly.
Your decision-making is just warped by the pressure. But the subtlety here, and this is a really critical point from the sources, is that poor risk management doesn't always look like a reckless gambler at a casino.
Right. It can look professional on the surface.
It can look almost professional. The trader uses analysis, they have a strategy, but they skip the rigorous, boring operational control. And that person, they look 90% professional, but that 10% flaw eventually destroys everything. A single, unexpected bad period wipes them out.
So if that's the massive downside, what's the actual goal we're aiming for? What is the real solution?
The real solution is simply survival. That's it. Risk management is not about avoiding losses. That's impossible. It is about staying in the game long enough for your skill to matter.
Long enough for your edge to play out.
Exactly. If you have a strategy with a real statistical edge, you need hundreds.
I don't like the word to stay on the game. It's not about to stay in the game. I don't know why this has come up in there. It's not about being stay in the game. It's about to be on the job that you're working on. You are a trader. You're working as a trader. This is not a game. It's based on probabilities. Doesn't mean it's actually a game. Okay, be aware of that. Very important. It's not a game. It's a job that makes you to live forward if you really have control of your emotions and you know how to play this forward. So work out your strategy, work out your backtesting, analysis, risk management, and moving forward to the rest of the other elements that we work on together. So guys, I think with this we can say a bit more, but not much more. Let's see what else we have.
Maybe thousands of trades for that edge to actually manifest. Poor risk management guarantees you will run out of capital long before that can happen.
Which brings us back to that core insight. The goal is just to control the downside consistently and let probability and time do the heavy lifting. Your entry signal is secondary to your survival mechanism.
And that leads to the definitive metric, the way you can tell a great trader from a good one. Great traders are not defined by how much they make when they are right. They're defined by how little they lose when they are wrong.
And with this sentence, we have completed the rich level of element number 5. So we're gonna go to the next podcast, and this was a great exercise for all of you to be aware of. We haven't gone into details, we haven't done much work yet, but we will. I hope you like it, and we're gonna continue working on those topics. So next one is gonna be a very interesting one, number 6. So see you on the next one, guys. Bye now.